Morning guys, Victor Delerme here. It's great to see you again. In today's video, we're going to be talking about 5 different ways that you can save taxes if you are a real estate investor. Number 1, you want to claim your deductions, right? Oftentimes, it's very simple. You can utilize your property taxes, repairs, or mortgage interest expense. These are expenses that you have to incur in order for you to keep the property. Just to maintain the property, you have to incur these expenses. But take a look at this analogy. If you own a piece of real estate that is cash flowing, right? It's giving you cash every month and it's appreciating in value. Yes, you then need to maintain the property. And the way you maintain the property is just to make sure that you are keeping the house clean. You have the repairs done, you pay the property taxes, you have a good relationship with the bank, and you make sure that you pay the note. And when you do this, right, when you make these payments, you are having a write-off for tax purposes. You can claim these expenses as deductions. But think about it. If you have the property on rent, the rental income is covering all these expenses automatically, right? So it's not coming out of your pocket or your own bank account. It is not coming out of your personal bank account. Your tenant is paying for these expenses. And guess what? These expenses become a write-off for your property, for your taxes. Okay, so your taxes, your tax base is going to be lower just by you paying these expenses that your tenant is paying for. Okay, so your cash flow is paying for this while your property appreciates in value. Now let's go to number 2. If you don't have time to manage your real estate portfolio, if you don't have time to manage your real estate holdings, you can invest through a syndicate or you can invest through a REIT. And you might be asking, Victor, what is a syndicate? What is a REIT? Well, in essence, in a nutshell, you're investing through a different company, right? You're putting your money, your capital, you're lending it or you're investing it into another partnership, into another corporation. And this corporation, this partnership, it's going to invest the money for you in their own real estate. And they'll manage the property for you. They'll pay the notes, they'll take care of the repairs, they pay their property taxes, they take care of the tenants, the upkeep, the rehab, everything related to the real estate, they'll take care of it for you. Since you don't have time to manage it, they'll be taking care of that for you. And of course, you have to pay a management fee for that. But guess what? Here's the advantage for you. You'll have cash flows, right? You'll have depreciation benefits. And also, while the property appreciates, you're going to participate in the equity gains of this real estate. Okay, so if you don't have time to manage real estate, you can invest through a syndicate or through a REIT. Number 3, by owning real estate, sometimes you have to improvements to the property. Sometimes you have to buy appliances for the property, right? Sometimes you have to make major renovations. So if you are making major renovations, or if you're buying appliances or equipment for the property, consider buying equipment or making renovations that are energy efficient. And why you want to do this? Well, number 1, you want to be able to save money on utilities, but also the IRS, the government, gives you a tax break if you invest in high efficiency equipment or high efficiency type of renovations in your property. So consider that. Why? Because it's going to give you credit. Right? So it's not going to be a deduction, it's going to be a credit. So if you owe taxes, here's what's going to happen. The credit is going to lower your taxes on a dollar per dollar basis. So if you owe, let's say $10,000 in taxes and you have enough credits equal to 10,000, the credits is going to offset the taxes that you owe, right? So that's why it's very important for you to consider if you're making a major renovation or you're buying equipment, try to make these high efficiency type of expenditures. Number 4, if you own a large real estate, right? If you own a big property, you can always rent out part of your real estate to your business. Okay? So if you do this, when the business pays rent, right? For the space that you're renting out to the business pays for this, it's going to become a business expense, right? So if it is a business expense, it's going to be a tax deduction, okay? But since you're the owner of the property, right, that rent that the business is paying for the property becomes tax-free for you. So it becomes a tax deduction for the business and it's tax-free for you. So you want to consider renting out a space of your property to your business. This is very good coffee. And number 5, if you are selling real estate, right? If you identify that your property, your real estate has a lot of equity, and when you sell, you're gonna have a nice capital gain, and you don't want to pay taxes on this capital gain, you can always roll over the capital gains into a 1031 exchange. And when you do that, you take the gains and you put it into another property, into the next property that you're buying, right? So you're basically deferring the taxes to the future, to the next generation, if you will, okay? And when you do that, that capital gain, it's going to be part of the tax basis on the new property. So it's not taxable, it's being deferred, okay? And this is when you become very smart, okay? So then what you wanna do is making sure that the next property that you buy, you take care of it. You make sure that it appreciates in value, making sure that you have the right and you maximize the rents, right? You maximize the value and you maximize the cash flows of it, because then your property is gonna be more valuable, okay? And remember that you roll capital, your capital gains, you roll it forward to this new property. And this property now is more valuable, okay? So now that since your property is more valuable, you have more equity in this property. You stack equity in this new property. Guess what happens? You can now go to the bank, and since you have more equity, you can refinance the loan of this property. The original loan, you can refinance it to better terms. You can actually extract cash out of this property. The original capital gains that you roll forward to this new property, and your property now is more valuable, you can extract the cash, right? And you can reinvest to a third property, or you can use the funds for other business expenses, right? As long as you're making the right choice, the right decisions with the money, you have the right to do that, right? Because in essence, you're leveraging your own asset, your own business. So the important thing is that you utilize the money properly and efficiently. Remember that you're pulling out, that's a loan, and you want to be smart about it. Okay, you don't want to do crazy things with the loans. You want to use the money to reinvest and for you to grow. So as you see, investing in real estate gives you a lot of advantages of increasing your wealth, having cash flows, and protecting actually the wealth that you've built throughout the years, right? So if you don't want to invest in stocks or bonds or mutual funds, you want to invest in something that's tangible, something that you can see, something that you'll have cash flows on a monthly basis, and something that's going to give you a lot of write-offs. Then real estate is definitely an option for you to invest in. I hope that you find this video useful, and we'll see you on the next one.